The world is sitting on a $300 trillion time bomb. And this is the reason why inflation will never end. So we know the US, they are inching closer towards a debt ceiling crisis. The fear has reached a point where it's pushing credit default swaps to the highest level since 2011. And this means investors are so afraid of a debt default that they are paying fire insurance on US bonds just in case the house burns down. But ironically, the biggest risk to the world right now isn't the US debt. Yes, America's debt is crazy high. It's at $31.4 trillion. That is the biggest pile of debt in absolute terms. But it is nothing compared to the global debt, which has hit a record $300 trillion. And it is 350% of global GDP. The leverage is so high that if this implodes, it could take down the entire global economy into the Great Depression 2.0. And I want us to understand the big risk that's building up in the system today. The Federal Reserve, they have been hiking interest rates from 0 to near 5% in less than 12 months. And this is putting enormous pressure on global debt interest payments, and the real damage is to the emerging markets. And this is how bad the interest rate hikes are becoming. Now, S&P Global, they did a shocking calculation that shows us the global interest payments for just the floating rate debt will almost triple. It will go from 3% to nearly 9% once the debt is rolled over and refinanced. And this means on average, companies and governments will be paying 3 times more the amount of interest just to stay afloat. And according to the IMF, this is unsustainable, especially for governments. They are projecting global government debt rising to 100% of GDP by 2028. Now, you might say it doesn't matter, right? Governments can simply print money to make the debt burden go away. They can simply inflate away the debt. But here's the big problem. Only the United States can feasibly do that. And when the entire house of cards collapses, the Fed will be forced to print money for the whole world. And this is possibly my most important video, because once you understand this, you quickly realize why the world is trapped in an inflation hell. So while the whole world is focused on the US debt imploding, the real risk is actually in the emerging markets. And they are the ones with the biggest debt trap, which has the real risk of default. And this might just be the black swan event that crashes the world economy. So why are emerging markets at a higher risk of default than the US economy? Well, it's for one simple reason. They issue a lot of their debts in US dollars. And according to the Federal Reserve, over 60% of foreign currency debt is issued in dollars. And this means countries sell lots of debt denominated in US dollars. When the debt payments come due, they need to pay bondholders back in the greenback. Now, if we just look at Latin America's dollar exposure, we see a frightening situation. A huge chunk of government debt is denominated in the reserve currency. Argentina alone holds over 50% of their sovereign debt in US dollars. But here's the big catch. Unlike the US government, which can simply print dollars through the Federal Reserve to pay back the debt, other countries can't really do that. They don't have a dollar printing press, so they need to either earn or buy dollars from the open market to pay back the bondholders. And every time the Federal Reserve hikes interest rates, it makes the interest payments higher for these countries, and it pushes them towards the brink of default. Argentina, for example, has been forced to sell their dollar bonds and swap them for debt in their local currency, the peso. And the reason is very simple. It will help Argentina save $4 billion in debt payments because their dollar reserves are being depleted. And this isn't good news. If enough countries begin defaulting on their dollar-denominated debt, we're going to see a big domino effect take place in the global economy. Remember, when you default on your debt, investors will be afraid of lending you money. So your bond yields go up, your economy slows down, and a recession happens. Now, if this happens to one country, it's a tragedy. But if multiple countries start to implode thanks to debt defaults, you can see how much of a big problem that will be. It is enough to spark a global recession, which will ultimately affect the United States as well. And this is why if things get bad enough, we'll see the Federal Reserve do a pivot and start lowering rates. They have to make the debt more manageable to service for the global economy. And as you have guessed, this is inflationary. When you lower rates, you make the cost of borrowing much cheaper. You kick the can down the road, not just for America, but for the entire world as well. And this is why the US will raise the debt ceiling. They cannot afford to default because it will cause an instant credit event. It will lead to a deflationary spiral that will almost certainly spark a global recession. And realize that the Federal Reserve's ultimate nightmare is deflation. It's not really inflation, it's deflation. And let's understand the effects this will have on the global economy. The first effect will be obvious. The US economy will self-destruct. We'll see bond yields in the US rise because investors no longer trust America to pay back their debt. This will cause the government to default on their obligations such as Social Security and healthcare, and that will be unthinkable. Over 60 million people in the US are on Medicare, and 75 people are enrolled in Medicaid, with the average benefit amounting to $1,100 per recipient. If a default happens, all these healthcare benefits could evaporate for the average person. So can you just imagine the amount of chaos that will happen on American shores? But this will also cause a global credit crunch. A default in the US will instantly trigger a dollar shortage for the rest of the world, and here's why. In 2021, over 33% of US debt is held by foreign holders. We are talking about countries like China, the UK, and the EU. Japan alone has over $1 trillion worth of US bonds, and if a default happens, suddenly this $1 trillion debt pile evaporates, the debt no longer exists, which means suddenly a huge pile of dollars will just disappear from the system. This will cause a swift and sudden dollar shortage, and this is where things just snowball out of control. Because the US defaulted, Japan now doesn't have dollars to settle its own obligations. Many banks and institutions in the country issue bonds denominated in dollars. For example, a Japanese bank is issuing a $2.5 billion bond denominated in dollars, guaranteed by the government of Japan. So eventually, they need to pay a yield of 4.3% to the bondholders every year, and in 2026, they need to repay the entire principal. And this means they need to have a constant supply of US dollars. But if there's a sudden dollar shortage, where is the money going to come from? Suddenly, the chain of default could spread across the world because I can't get enough dollars, so I can't pay dollars out as well. Every investor along the chain will be affected, and all these defaults will cause a big deflationary spiral where the money supply around the world suddenly shrinks and collapses, and asset prices across the board will also go down. And this is the last thing the Federal Reserve wants to see. The whole world becomes poorer, they start consuming less, and in today's consumer-driven economy, this will spark a daily recession. And this is why it's very unlikely the US will default, because it isn't just a recession that will occur, it will ramp up the dollarization like never before. There are already 101 reasons for countries to de-dollarize. A debt default will just be the final nail in the coffin. It will be the ultimate excuse to dump the dollar. And this is why the US won't let this happen. The debt ceiling will be raised to keep the game going. It's better for a slow erosion of the dollar's reserve status through inflation than an outright collapse from a default. And this is why inflation will never end. When push comes to shove, the Federal Reserve will have to print money to save the world. And this is the curse of having the reserve currency. If the emerging markets start to break, or even the developed nations, the Fed will have to print trillions of dollars to stop the defaults from happening. The Federal Reserve will be the final liquidity backstop for the entire world. So how will this happen? Well, the Fed will have to send all this newly printed money to the central banks of the world, and they are likely going to do this through the swap lines. And that's why we saw a coordinated move by global central banks to stand by their swap lines to flood the system with dollars in case of a credit crunch. Now, swap line is nothing complex. It's basically where foreign central banks swap their own local currency for US dollars from the Fed. In reality, they will likely just print up their own local currency in exchange for dollars that were in turn printed up by Jerome Powell. So what we have now is a global money printing scheme going on. Suddenly, global dollar debt is suddenly paid off and the world is flush with cash. Creditors have gotten back their money and the money supply has increased thanks to money printing. But here's the big problem. It is no longer debt that is stuck in the system. It is now cash on hand. Investors now have a ton of money to go back into the market and start bidding up the prices of everything, right? They'll buy even more bonds, stocks, and commodities because they know the purchasing power of cash has been devalued. And this is where the strength of the dollar will collapse because now there's a flood of the reserve currency circulating around the world. Essentially, this is a global QE where inflation is spread all around the world from the Federal Reserve. And the only other alternative is a daily deflationary spiral, which could lead to a global depression. But here's the big problem. No matter who defaults first, the US or emerging markets, it will be a disaster. There's no happy ending. But because the dollar is the reserve currency, the rest of the world will likely implode first. The dependency on the dollar will force the world to scramble to get even more of the currency, no matter the scenario of who defaults. So let's assume the emerging markets collapse first. They start to default on their dollar debt. And this will cause a big credit collapse and we'll see a run to the safe haven asset, which is still the US dollar and treasuries. And this will cause the dollar index to soar and trigger massive currency devaluations for the rest of the world. countries will have to print money to acquire dollars for trade. So local inflation will soar, and this will trigger a global inflation wave. Now, if the US defaults first, and I mean not paying back bondholders completely, it will also be a nightmare scenario. There will be a sudden dollar crunch, and it will be so swift that many other countries could begin to default on their own debts as well. And what will this mean? A deflationary debt spiral unless something is done. And this will cause the Fed to step in and print trillions of dollars and flood the world with liquidity. And once again, the money supply increases and inflation soars. So either way, inflation is the end game. It is the name of the game. If either default happens, there will be a collapse that will still lead to an inflation nightmare. Sure, in the long term, the dollars will become a hot potato. Countries will start to unwind their dollars and they'll start to flood back to the US to buy up assets. And this is when inflation finally boomerangs back to the US. But this is my bet. I don't think that will happen because the Fed will likely choose to inflate the problem away at the front end and prevent a collapse. And for you and me, this means a gradual inflation hell that will never end. And this is why we advocate holding hard assets. And as we head towards a recession, when we see asset prices come down, it's time to accumulate real tangible things of value because that is the only place that will store your purchasing power for the long term. And it doesn't have to be just gold or silver. It can be real estate or farmland as well. And this is a global problem. The Fed is going to lower rates and print money sooner or later to push bond yields down. And once the recession strikes, the Fed will have to print money again because the only way to fight deflation is with inflation. And realize that a stronger dollar is very bad for the world, especially if it strengthens too much. Every time a recession strikes, the dollar spikes up, and this forces the Fed to eventually ease their policy and print money once again. And we can see back in 2008 and 2020, the dollar index spiked up dramatically, and that's the blue line. A stronger dollar that spirals out of control is bad for the US economy as well. And because of this dollar curse, the Federal Reserve will have to print money and buy up all those bonds to weaken the dollar once again. They need to stimulate the global economy. And from the red line, we can see during the last two recessions, the Fed went in and increased their balance sheet, and this helped to push down the dollar. But at the same time, this also erodes the purchasing power of the dollar. We mustn't confuse the two. Just because the dollar index rises doesn't mean the US dollar isn't losing value. And we can see over the years, the dollar index has gradually gone up, but the value of the dollar has gradually gone down at the same time. So these two are mutually exclusive. And the reason is simple. When you print money, you lose purchasing power. It's not rocket science. And that's why whether you live in Asia, America, or Antarctica, you need to buy assets that hold value because the Federal Reserve will inflate again sooner or later. And if there's a debt default, power will be forced to print and you win. If power prints money to avoid a default, you also win. So we got to understand how the entire financial system is set up. We are living in a credit-based economy where you need to keep cheap money flowing. You need to constantly inflate the bubble or the entire system will implode. And if we look at how things are going, it's very obvious that interest rates can't go much higher any longer. We are likely going to cap out at 5.5 or 6% at the higher end. We just need to throw back to March when SVB collapsed thanks to higher interest rates. The Fed capitulated. They threw in the towel and saved the banks. They created the emergency backstop to pump liquidity into the system, shielding them from $300 billion worth of losses. They took all the underwater bonds for collateral at par value and gave the banks money to shore up their capital requirements. Why? Because they knew what happened was essentially a dollar squeeze from bank depositors. And the same thing is going to happen if foreign banks are all scrambling for dollars at the same time to pay off their debts. They will rush to their central banks for the reserve currency. And those central banks will have to do one of two things. Either they get the dollars from the Federal Reserve from their swap lines, or they print up tons of local currency or use their reserves to buy dollars from the open market. Both methods are inflationary. The end game is still inflation. But let me know what you think in the comments below. Will the US default on its debt, or will the global debt bubble, especially the emerging markets, implode first? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.